In Cornwall, we have Marcel on the phone line. Hi there.
Hi, Mark, David. I'm calling. My questions in relation to Alimentation Couche-Tard. It's been a fairly long-term holding for me, and the rates of return have been really good, including this year, like near double digit. Just concerned somewhat, or just wondering, like, what your perspective is on this stock as a near and long-term holding.
Great. Well, first of all, Marcel, congratulations. One of the best performing stocks in the Canadian market. We own Couche-Tard and have for some time, and for good reason. You know, really well managed company, have been able to grow very effectively through acquisition. They've been able to buy under-managed assets and use their processes and their standards to add to those businesses. They've got a great business model. They're growing. They've got lots of room to grow in the U.S. and internationally. It's in the right group. Certainly, you know, the consumer who has a bit more money from the gas tank goes and spends it in the convenience store in the gas station, and Couche-Tard does okay doing that. So, you know, look, there's risk in every business model. There's risk in themes. But at this point, with oil hitting new lows, or basically at the lows, and looking like it's going lower, I think that this is a company that can continue to perform really well.
Here's Frank, who's in Montreal. Good afternoon.
Yeah, thank you, Mark. Dave, tell me on TransAlta. I bought some TransAlta 25, bought some around below 20. I bought some at 15. I bought some at 9. Where's going from here besides a good dividend? Should I get out? Stay in, buy more? Thank you, Mark. Thank you, Dave.
Okay, that's a lot of averaging down.
So, Frank, there's a few things to take away from your call. One of the big risks in investing for dividends is forgetting that you're investing for total return. Total return is the combination of the dividend you receive on one side and what the share price does on the other, and ideally you'd like them going in the same direction. Very often what looks like a good dividend may be a bad investment if the company is not in a position to grow the dividend, or in fact may be at risk of cutting it at some point. TransAlta is in a business that is not economically sensitive, so it doesn't participate in improvement in the underlying economy. A lot of the companies that are performing well right now are companies that are economically sensitive, not interest rate sensitive, which some of the utilities are. They are not in a position to grow their dividend. So for dividend investors, they've got a choice as to where to go. They tend to be focused on those that are likely to increase it next year and increase it the year after that and increase it the year after that. So I would avoid this group as a whole. Things that are tied to the bond market, I think, are going to have a tough go. The second thing is, if you're going to buy a dividend payer, and there's lots of great ones, make sure it's one that can grow its dividend. I don't think TransAlta is in a position to do that. And the last thing I want to say is, please, please, everybody, be careful about averaging down. You know, if you have 10 stocks and you put more money in your worst performing stock, incrementally you're increasing your risk. And I would argue that as opposed to averaging down, you want to use stop losses to protect yourself from a little mistake turning into a big mistake, and be prepared to add to the ones that are working, because great companies tend to continue to be great and continue to get better. They have an easier time hiring the best people. They have an easier time raising capital. They have an easier time being profitable. So I would avoid that TransAlta stock, and I just try to avoid that trap.
All right, sound advice. One last question before we do a market call minute. Avinash is in Calgary. Hi there. Hi, Avinash. Are you there? Okay, Teva Pharma, which made that huge deal with Allergan the other day, buying the generics business for billions.
There is just a tremendous amount of mergers and acquisitions going on within the pharmaceutical space. This is an industry where there has been pricing power. The pharmaceutical companies have been raising their prices, and there's been a lot of deals that have been done where you put two like companies together and then cut a whole pile of expenses. And Allergan has been a master at that, frankly, up to this point. Teva's been very good at it also. I think that we're in the kind of market where this sector has a tailwind to begin with. Mergers and acquisitions are likely to continue. The market voted with their dollars by saying, Teva, you did a great deal. Stock price jumped on the acquisition. If you go back 5 years ago, a company made an acquisition, their share price went down the next day on the uncertainty that might come from these deals. So many of these deals are working that people said, oh, here's an opportunity for Teva. So I'd buy the stock, and I'd probably buy Allergan as well.
As mentioned, the Market Call Minute is coming up right now. We got a question from Andrew in Toronto. He called in about Pembina Pipeline.
Probably the lowest risk part of the energy chain. I would just avoid the whole sector as a whole. You'll get paid, but I think you're not going to make a ton of money.
Jeff in Edmonton, he wants to know about AIG. Do you still hold that?
We own it. It's our single biggest position at the firm. Lots of opportunity for optimization of their financials, and can continue to grow. Insurance is a great sector in the U.S. market right now.
A tweet from @Dave Trotter on Apple.
We've cut our position in half after being a long-term holder. Stock is underperforming. The financial metrics are strong and we think are likely to continue to strong, but we have to take the price signal, which is that the stock's underperforming, and carve back our stake.
An email from Janet on Walt Disney. Is this over-the-top threat to ESPN?
We cut our position in half. It's negative on the broadcast side. They have so many great pieces of the business. We think it overwhelms the weakness in the broadcasting, but it is 40% of their business. We need to see how the stock acts, 2-3 weeks after the earnings have come. I think this is a great company, but don't like the broadcast piece.
We'll take a break here with David. We have top picks coming right after this, a big U.S. bank, and 2 others. Stick around for those.